What is up, you guys? Pete DiCarlo here, and I've been getting a ton of comments from you guys and from my private Discord, from Twitter, asking me to do a deep dive on FUBO TV. So here it is. If you guys like more deep dives looking into companies, getting my opinions long term, if I would invest in these, as somebody who's been trading and investing full time for a living for the past 7 years, then hit the subscribe button. If you are more into trading, I do have a second channel called Traders Helping Traders. Go and check that out. I post daily videos on trading setups, what I'm trading, technical analysis. But on this channel, we talk mainly about long-term investing. So hit the like button, subscribe, and let's talk about FUBO. All right, so taking a look at FUBO, this company has been on a tear and most recently a pretty significant fade over the past year. If we take a look at a 5-year chart of FUBO, you can see that really from 2019 all the way up until November of 2020, the stock just kind of sat sideways, right? Traded between $20 and $5, which you could say that is a massive jump, right? Like that channel is about a 500% channel, but we did trade basically sideways between that channel for about 2 years. Now, very recently, within the past year, the stock went on a massive move from that $9 price point all the way up to $60, has significantly pulled back, bounced at a strong support, and now we're sitting here at $27, which leads a lot of people to ask, is FUBO a good investment? Now, there are two tools that I like to use for assessing long-term investments. The first is called Morningstar. I have the premium version. It's like $30 a month. It is a little bit more money than something like Simply Wall Street, which I do like as well. Morningstar is like $30 a month. Simply Wall Street's like $10 or $15 a month. I actually don't have the premium one, but both of them are great tools. You can use something like Yahoo Finance, but this is great in my opinion to just do like a quick little rundown of a deep dive of a company, maybe a 10-minute analysis before you start spending hours and hours and hours looking at a company, which obviously I don't have the time to do that here for you guys. But if those of you who do not know what FUBO is, FUBO TV is a sports first live streaming company. So looking at this company, think about basically Netflix, Hulu, but for sports specifically, which neither of those have, right? So FUBO is a sports first TV live streaming company offering subscribers access to tens of thousands of live stream sporting events annually, as well as news, entertainment content. So it does have other things in sports, but that's predominantly what it is. Its platform, FUBO TV, allows customers to access content through streaming devices on smart TVs, mobile phones, tablets, and computers. The company offers subscription, a live TV streaming service with the option to purchase incremental features available for purchase that include content or enhanced functionality, basically attachments best suited for their preferences. So FUBO did actually get a pretty big deal with a major TV maker in the past week or 2 weeks. I'm sorry, that's why we saw this big push here recently, basically that they were going to be in all of their TVs. So it's kind of like how Roku, when they first started, that it wasn't that big of a streaming platform, and now Roku is essentially on every single TV. That's what FUBO is trying to be. There's also been some recent news that they got the rights to, I believe, the semifinals of the World Cup. So pretty big. This company is still very small. You can see a market cap of $4 billion. I consider a very small company like under $4 billion. Under $10 billion to me is still a small company. So nothing too crazy here. You see we are trading right in the middle of its 52-week range, but this range is insane, right? So this range is lows of $8 to highs of $62, which is nuts, right? If you got in at $8, you made 6 times your investment in not only a year if you would have sold. The consensus forward PE is nothing because this company is not profitable, which is something that we're going to talk about. Most recent earnings were March 21st, 2021. We're going to take a look into those. Sector, like we said, is communication services, and stock type is speculative growth. Now, taking a look at some of their competitors, like we said before, Netflix is the main competitor. Netflix is a freaking monster, right? Like everybody knows what Netflix is. Everybody knows what Netflix does. Netflix is absolutely insane with a much, much, much higher market cap. And to me, I actually hate Netflix at this price. They have it rated as a 1-star, and I would completely agree. I do not like Netflix at all. I would have to be buying Netflix at like $200 to $100 in order to be entering this, but I can make a video on that in the future. If you want me to make a video on Netflix in the future, let me know and we'll take a look. So right now, today, we're trading at $27. A lot of people asking me if this is something that I would start to look to long term. We're not at these astronomical values of $62, but I don't really think we'll ever see $8 ever again, in my personal opinion. Something that is important is short interest. So the short percent of float is 18%, which is nothing absolutely insane, right? Like an AMC or a GameStop, but it is pretty heavily shorted. It definitely is, right? Right now, there's 23.51 million shares that are short, and the shares outstanding is 140 million. So decent size when it comes to, their short interest. Taking a look very quickly at their financials, like we said before, they are not a profitable company. One thing that I like to always look for is to see if revenue is growing. And you can see from 2018, 2019 to 2020 and 2021, well, at least the trailing 12 months, that's what TTM means. You can see that the revenue has been growing, but something else that's bad is their operating income is continuing to grow in the negatives. Their net income is continuing to grow in the negatives. And one thing that we'll talk about later on is this company really is diluted. There's a big issue. They really have diluted a lot of their shareholders, which is never a good sign, right? To do share offerings is never really a problem, in my opinion, long term, but to dilute your shareholders is always going to be an issue. If we take a look at total assets, something that I like to see, like I've said before, is growing total assets. And right now they're about $1.19 billion in assets in Q1 of 2020. However, their liabilities have significantly grown. So almost a double in their liabilities from 2020 to 2021. And, not nearly a 100% gain in their, total assets, but still a very good move to the upside. Their total debt has gone up significantly from 2020 to 2021. Their total equity has gone up substantially, a little bit, from 0.62 to 0.68, and cash equivalents has gone up significantly. So the 3-year trends across the board is going up. However, even though, like I said, we have greater revenue and greater assets going up year over year, we do have higher and higher liabilities going up. And to me, that's not something that I want to see, right? It's not hard to, I don't want to say fudge, but it's not hard to get higher and higher revenue if you're putting more and more money into the company and therefore losing more and more money, right? Think about it like, it's going to be a pretty good example, like Facebook ads. Let's say your company did $100 million this year via Facebook ads, but you had to spend $150 million in those ads. Is that a good investment or a good return on your money? No, it's not, because even though you can say to people, I did 100 million in revenue, you spent 150 million to get that 100 million. So that is not a good investment. So overall, nothing too bad from FUBO on the financial side, but we're going to start and move over to Simply Wall Street. This is a great tool I like to use, simplywall.street. You can look over like 150,000 companies. I have no affiliation to this company, but I really, really do like them. And it's a great way to, quickly analyze companies that you want to look into. So I do recommend it. I think the free version, you get like 3 reports a month. There's like a $5 version where you get like 10 reports or 30 reports or something like that. And then there's like an unlimited one for like $20. But if you are a long-term investor, I do recommend this. And I don't pay for the premium because, to be quite honest, I don't really look into long-term investments that much anymore. I do it for this channel, but I feel like there's just so little companies that are of value right now that I wouldn't be overpaying for, that I just really have not been investing long-term, except for actually EDU, which I'm going to talk about in a different video. But overall, you can see right here that they give you this cool little, like, I guess, radar system from value to its future, past, health, and their dividend. And you can see that really there's not a ton of value, and there's no dividend at all. And the past is not a high rating because obviously the company has not performed in a significant way within the past 5 years. But the executive summary, obviously we talked about what FUBO is. Some of the rewards they are giving it is that it's trading 47.3% below their fair value estimate. Now, one thing I will say before we get into this Simply Wall Street report, I think that their fair value is very, very, very generous. I do not think its fair value is anywhere near what they think it is, but it's okay. Another reward is that their revenue forecast is set to grow 38.57%. Some of the risk factors they have is that they have diluted their shareholders substantially in the past year. So for those of you who do not know how dilution happens, let's say that there are 100 million public shares out on the market and the stock rips 500% a year. Well, one of the ways that a company can go out and raise money is go to a bank, which is never a good idea in my opinion. So what they could do is actually sell more shares to the market for a specific price. So let's say the stock went up 500% that year. Well, they could actually offer another 100 million shares out onto the market and they will make a ton of money, which can be used to reinvest in the company, grow the company, pay off debt, which long term is not a bad thing. But in the short term, now you have double the amount of shares out of the public market, which means your shares are therefore diluted significantly, which is never a good sign. So are their forecast, achieving profitability? So they're expecting profitability over the next 3 years. I saw FUBO release something saying that by 2023, they plan to be profitable. One of the things is the share price liquid or stable? Volatile share price over the past 3 years. We talked about that. Trading ranges from $8 to $62. I don't really think that we're going to see anything along the lines of being around $8 ever again. I really, really don't. So obviously FUBO is more volatile than 75% of the US stock market. That's obviously true. We've talked about that. In the past 7 days, stock is down 2%. In the past year, the stock is still up 166%. So FUBO has exceeded the US interactive media and service industry, which returned 63% over the past year. So overall, basically doubling what its sector has done. FUBO exceeded the US stock market return of 44%. That's insane. I mean, it's not insane that FUBO doubled the US stock market, nearly quadrupled the US stock market return. It's insane that the stock market's up over 43 or 44% a year, even with that, fade last year. So long-term price volatility versus the market. How is FUBO's share price compared to the market industry in the last 5 years? Obviously, it's very, very high. Valuation. This is what I really wanted to go over when we were looking at this, is the valuation and the PE. Now, Simply Wall Street has a valuation of being 47.8% undervalued versus fair value. So fair value, how do I explain it? It's kind of a crapshoot number in my opinion, right? Especially if a company is not profitable. If a company is profitable, it is pretty simple to figure out what a fair price is for the stock, because you can look at the earnings, you can look at what its future PE is. Say it's trading at a 50 PE, you could see what a 25 PE would be, and then you can figure out what that price is. Right now, they have a fair value of 56.44%, and they are stating that it is currently undervalued extremely. I personally would contest that. Right now, we're trading at 30 bucks. I think fair value is about 20. I really do. I think that, and here's the thing, fair, maybe if you're buying at 30 bucks, it's fair. But I think that if I wanted to be buying FUBO long term, I would need it at like $15 to $20. 30 potentially could be fair right now, but I do not see $56 being fair. I think that if you're buying FUBO for $30, you're buying a very, very, very risky company that has increasing debt year over year, increasing losses, not looking too hot right now, but a company that has a massive future, right? If you look at something like Netflix, they had the same type of situation, very, very risky, very, very volatile. And I think that $30 is the fair value, and I would really be buying, personally looking to take a position at about 25 bucks. So I don't think it's, 40 something percent undervalued, but I do think that it's at an attractive price. Like we said before, price to earnings ratio, there is no PE because this company is not really profitable in the slightest. By 2023 could potentially be profitable. And future growth. How is FUBOTV forecasted to perform over the next 1 to 3 years based on the analyst, rankings? Some people have this thing, being absolutely insane, but they're forecasting at a 13.4% annual earnings growth, which is not bad. So overall, guys, I like FUBO. I really do. I feel that when I do these deep dives, I kind of start to fall in love with companies that I really didn't like. I think that there was a lot of fundamental reasons for FUBO to rip over the past year. I think that it got ridiculously overhyped. I think that there are a lot of great companies that became these quote unquote meme stocks, you know, stuff like Plug, stuff like Blink, Neo. A lot of these companies, you know, are good companies, very risky, good companies though, that were just overinflated price wise. And a lot of these companies took advantage of it by, you know, not in a bad way, but like struck when the iron was hot and diluted the crap out of their shares because the stock was up, you know, 400, 500% at one point. I mean, from $8 up to 64, the stock was up 500%. Why would you not sell shares to the public? Even if you're diluting the crap out of your shareholders, it gives you a ton of working capital to therefore go out and make better business decisions. Overall, I really like FUBO. I would like to enter a position on FUBO, to be quite honest. The biggest issue for me with FUBO, and like we've talked about before though, it's not that good of a deal. Right now, I think that if you were to buy FUBO and hold it for the next 5 years, it will give you amazing returns. I think that it's a good company, not great, it's a good company at a decent valuation. If FUBO were to get back down to like $15, see, I didn't really do this type of deep dive when it was trading at 15, and I really should have, but when it was trading at 15, I was very worried about it snapping 15. From a technical standpoint, which we'll talk about one last thing before we hop off here, because I normally don't talk about technicals when it comes to this, but we had a very strong support at 14, 15 range. If we snapped that, we were heading down to 8, and 8 was where I was really planning to buy. But overall, I really like FUBO. I don't think you're getting a good deal. I think you're getting a fair price. But one thing I will say, though, as far as FUBO is considered, do not think that this is not going to be a volatile ride. Do not buy at 27, and if it dumps down to 14, sell, right? Like if you're somebody who's buying at 27, you got to be ready to hold this MF for the next 5 years, whether it goes, you know, up to 60 or down to $8. You got to be ready to do this. I've talked a lot about this when I've been breaking down like SPCE, when I was breaking down SDC, which I took a big position in recently. You know, you have to be ready to hold these volatile movements. It's just part of the game. So overall, guys, thank you for all of the support. If you want to get access to every single trade and investment that I take as soon as I take it, you can live stream at me and my team just like this every single morning for the first hour of market open. Get access to our 60-hour course library, which teaches you everything that I've learned in my past 8 years of trading full time, as well as get access to our private Discord. Use the code Academy90. Start for $10 your first month. Give me a follow on Twitter, guys. Thank you for all the support, and I'll see you next time.